Your cursor hovers over the TradingView entry box, while a 5-minute candle breathes. RSI prints 31, price ticks a low. Then there it is, the tiny uptick on the oscillator, while price nudges one step lower. Classic bullish divergence. Your thumb slides the stop loss a few pips under the sweep. Adrenaline flickers as you picture a snap back to VWAP. Level 2 thins. Order flow shows sellers hitting bids, but slower. This is the turn, you whisper. The platform beeps as your limit arms. The next candle wicks lower, grabs the round number stops, and the RSI blips higher. Dopamine paints a green arrow. Cortisol sketches a red one. Your mouse floats over buy, fingertip hovering. Risk defined, reward imagined. You inhale for 3, exhale for 4. Somewhere between breath and click, you forget the simplest rule. Divergence is not an entry signal. It is a description of momentum, not a plan. You click, price flicks, the stop holds. Then a push prints a low, and the oscillator climbs again. You add because the indicator says you're right and the account says you're not. You didn't just trade RSI, you traded a picture your brain painted on candlesticks. Humans are pattern-making machines, and markets are random enough to feed illusions, while structured enough to make them feel true. Mark Douglas warned that markets are unstructured. Our beliefs rush to fill blanks. And when we crave relief from drawdown, a slowing oscillator becomes a promise. In Trading in the Zone, he hammers probability thinking. Any setup can fail, and certainty is the most expensive drug on the platform. Brett Steenbarger adds the performance angle. Attached to one scenario and you stop rehearsing what ifs. You stop adapting. That is chart pattern hallucination. RSI divergence is the perfect canvas because it feels scientific, it draws a crisp diagonal, and it whispers a seductive story. Momentum is fading, so price must reverse. Dopamine loves that story. Each green uptick in P&L pays a reward. Soon you chase the feeling. Then red positions spike cortisol, narrow your vision, and you fixate on indicator confirmation while ignoring the tape. During fast volatility, adrenaline speeds clicks and shrinks patience. You yank stops, you enter early, you exit late. After a string of losses, serotonin dips, confidence sags. You cling to divergence because it looks objective when your mind feels shaky. Here's the trading paradox. The more you analyze a single signal, the worse you trade it. You start curating evidence for the entry and rejecting evidence against it. Tighter stops create bigger losses because the market pokes your obvious level. You scratch, re-enter, and repeat until size grows, and the loss is final. The best trades often feel uncomfortable, like buying when the indicator is still oversold, but the order book shows absorption and the 5-minute closes back inside the level. Perfect-looking divergences often fail because everyone sees them. Everyone crowds the same stop, and price moves where the liquidity sits. Market wizards echo the same theme. Most traders lose money because they want to be right, not manage risk. They fight the tape. They mistake a picture for an edge. The way to trade push is the opposite. Mechanical rules that survive moods. A rule like no counter-trend divergence entries, unless the session is mean revert probable and a stop run just occurred. Sounds boring. Boredom is discipline. Psychology 2.0 reframes it. Your job isn't to suppress emotion, it's to build processes that channel emotion into review, creativity, and adaptation. The invisible cost of divergence-only thinking is opportunity. While you wait for the oscillator to agree, clean price action without divergence makes the day's move, and you miss it because your lens is too narrow. Past patterns don't guarantee the future. Most traders lose money. Risk management is survival, and indicators are context, not consent to click. The costly pattern plays out the same way. You spot divergence at labelled support. Front-run the entry before structure confirms, and then you widen the stop because it's just liquidity. Price slices the level. You average down on the next divergence because the oscillator is even stronger. Confirmation bias turns the chart into a courtroom where you argue for your trade, ignoring order flow showing heavy offers, ignoring the daily trendline break, ignoring that the session is risk-off with breadth bleeding. Then the tight stop you refuse to take becomes a wide drawdown you rationalize as swinging it. You watch the weekend creep closer and tell yourself you'll hold because the market will gap back up. Sunday night futures print lower. Monday opens with a flush. You close the position near the exact point you swore you'd never hit. That's the revenge trading loop in miniature. The more you need to be right, the more you trade to get even, and the more the market taxes your need with slippage. You stare at the 1 minute, 3 minute, and 5 minute RSI at once, and every micro blip feels like a signal. You overtrade compulsion into noise. And because the first divergence that finally works often does so without you, since you're shell-shocked, you come back the next day, determined to take the very first one you see. Meanwhile, you post a curated screenshot of the single perfect textbook divergence in your journal and skip the 3 that wrecks the P&L. No deliberate practice, no sampling across timeframes, no review of order flow context, just lines and feelings. It's expensive. It is also avoidable. It hurts slowly. Meet Marcus, the algo hybrid. He trades NASDAQ futures and USD on $1, $5, and 30-minute timeframes. He watches candlesticks, level 2, order flow, and volume profile. A third screen runs stats. He tracks one thing ruthlessly: regime. Before New York Open, Marcus builds a distribution. Overnight range versus 20-day median. Realized volatility versus implied. Sector breadth, put-call balance, and an imbalance score from absorption. He tags the morning trend probable or mean revert probable. On trend probable days, he only takes divergence with trend, after a pullback and a 5-minute close back in the direction of the drift. On mean revert probable days, he needs a stop run, sweep, trap, reclaim, plus cumulative delta flipping. Entries scale 1/3 on signal, 1/3 on confirmation, 1/3 on first pullback. Exits scale at 1-to-1. VDUAP or value edge, then a runner with trailing. He codes the logic into alerts to prevent staring contests with the screen. He learned the hard way. Early on, he ran a pure discretionary playbook. Mark support and resistance. Watch RSI for divergences. Take 3 shots. Hope one pays. He journaled screenshots. Winners clustered when divergence aligned with a fresh order flow shift. Losers clustered when it fought trend or printed inside value with no trap. Douglas called it perceptual distortion. Marcus called it tuition. So he built guardrails the way to trade. Prescribes mechanical rules for entries, stop-loss placement, and scale-outs while keeping discretion for context. He wrote one page he could obey on red days to keep adaptation alive. He applied Psychology 2.0, weekly reviews that measured process, not just P&L. He tracked expectancy by signal, tagged mistakes, entry hesitation, exit greed, stop-loss removal, overtrading, and A or B tested filters. Results were uncomfortable. The best trades felt worst at the button. The prettiest divergences underperformed. That paradox became a rule of thumb. If it looks perfect to everyone, he needs extra confirmation, or he passes. Market wizards taught him to respect risk, so every trade started with maximum loss, defined to the tick, and finished with a written post-mortem. He kept size honest every day. The rewiring looked boring from the outside and life-saving from the inside. He built a pre-market routine that killed pattern hallucination. 10 minutes for narrative, risk, macro calendar, overnight news, sector leaders. 10 for stats range, realized volatility, drift, gap odds. 10 for structure overnight highs or lows, prior value area, VWAP, moving averages, key levels. 5 for if-then triggers. If RSI divergence appears against trend in the middle of value, no trade. If divergence prints after a stop run and the 5-minute candle closes back inside, consider a starter with a stop below the sweep. If absorption appears, cumulative delta flips and breadth improves, add on first pullback. His checklist sits beside the keyboard like a flight manual. Under stress, the body still tries to sabotage him. On hot streaks, dopamine makes him chase the first divergence that blinks. He counters with a rule from Douglas. The market is always right, and the only thing you control is yourself. So he binds biology with process. When green P&L tempts overtrading, he enforces a daily max trade count and switches to sim after the cap. When red positions spike cortisol, he reads his flight check. widen to 30-minute, verify regime tag, reevaluate, box breathe, then decide. When boredom whispers for action, he stands up, starts a walk-away timer, and lets alerts watch. After any stop-loss removal, he enforces a 15-minute cooling off and a note on why the rule bent. He treats overtrading like speeding. Automatic penalty, smaller size for the next 2 trades, then probation lifted. Exits use brackets that scale to session volatility, so he can't drag targets closer out of greed. His journal template comes from Steenbarger. What did I plan? What did the market do? What did I do? What did I learn? What will I change tomorrow? He tags setups by context trend, probable or mean revert probable, and charts expectancy by bucket. He keeps a paradoxes page. More analysis can hurt. Tighter stops can grow losses. The best trades feel awkward. He finishes with market wizard's humility. Most traders lose money. Past patterns don't guarantee future outcomes, not financial advice, and risk management is survival. Then he shuts the journal and sets alerts again. He resets focus and posture. And then something subtle changed. The same RSI plot that used to hypnotize him went quiet. Divergence still flashed, but it no longer decided anything by itself. Markers could watch a lower low with a higher oscillator and feel no tug to click, no itch to bottom ticket, no identity to protect. Just a checklist. Stop run into level. Absorption. 5-minute reclaim. Improving breadth. Order book agreement. Session regime. If yes, he entered 1/3 size. Stop under the sweep. First scale at 1-to-1. Second at value up. Runner to value edge. If not, he waited. On days the trap sprung, he took the loss and wrote 2 lines. What was my plan? What will I change? The P&L smoothed, not because RSI improved, but because his mind got quieter and his rules got louder. He still missed trades, still had red days, still felt adrenaline during volatility. But now the chemistry served the process. He could close at the bell with capital intact. Notes written, alerts set, and no need to chase. Tomorrow would bring new candlesticks. His job would be the same.